Well, hello, this is Chad Franzen with Authentic Counsel, and today I am recording this on May 1st, 2020 as a month end for April review of the current markets and economy. And again, this information is as of April 30th, 2020. And again, Chad Franzen here with Authentic Counsel. You can find out more about what we do in working with families on financial services and investment planning at AuthenticCounsel.com. And I'm going to be going through a few slides today just as a summary of where the markets are. And again, just by way of introduction, Authentic Counsel is a registered investment advisor, and we do believe it's important for you to seek tax and legal advice. This is presentations for informational purposes only, and you do want to consult with an advisor before taking specific investment recommendations. Let's get started. One of the things before I jump into some charts on the market that I wanted to go over is really the process from a high level of how we look and think through capital markets and the economy. This is a slide from a research firm that I think really represents the process that we take with families that we work for. And if you look at it on the left-hand side, we want to have a disciplined framework to where we look at the macroeconomic features, we look at the fundamentals, we look at the technicals, and then we look at behavior or sentiment factors. And we also have sector influences, such as what's going on in healthcare or energy or other types of sectors of the economy that are important to give us a framework or a process. And then from our framework, we have a process for what's going on at a macro or high level view of the economy. So if we're looking at things from a 30,000 foot, we want to have a macro view of what's going on with GDP and inflation and employment and what the Federal Reserve is doing. Then that's going to help inform us of how to make important investment decisions. On the right side of this chart, you'll see strategy asset classes. So these are the different sectors of the economy, and depending on where we are in the particular part of the economic cycle, whether it is we have inflation or growth or deflation or contraction, that's going to have an impact on what types of asset classes we want to invest in. Currently, right now, with us being in an economic recession, some of the sectors of the economy that are more favorable to be in include sectors like healthcare, consumer staples. Those are two of the bigger ones, to a lesser extent, utilities as well. This chart really represents what we just presented, in that if we broke the economy at a macro level into four different squares, the GDP, which stands for gross domestic product, is either increasing or it's decreasing, or somewhere in between. If the economy is growing, then it's going to be in either box 1 or 2. We call these quadrants. If the economy is slowing down or contracting, it's going to be in either box 4 or box 3. Likewise, on the vertical axis, inflation, if it is going up, if it's increasing, then it's going to be in quadrant 2 or quadrant 3. And if inflation is going down and perhaps even going into deflation, it's going to be up here in either quadrant 1 or quadrant 4. Now again, as we plot where we see the data coming in and the other factors from the previous chart, that's going to help us have a view on where we are in the economy. So currently we have quad 4 highlighted, and that the economy is decelerating because of the coronavirus pretty violently into a recession, depression levels on the economic growth. And we don't have inflation right now. We have actually zero inflation to potentially deflation. So that puts us in this quadrant. So this is helpful for us as we look at, well, how do we have a process and not be emotional when we look to what types of investments to invest in. And again, this slide has a lot of information, but depending on the quadrant that we're in, we believe that different sectors of the economy are going to be more profitable to be in. And for example, in quad 4, we see that these asset classes that are highlighted in green, those are the asset classes that are more favorable to be in when the economy is in a contraction phase with low inflation or deflation. So you'll see that it is more profitable to be in fixed income, in US dollar, healthcare, consumer staples, REITs, utilities, and there's other type of factor weightings that we look at as well. Conversely, there are parts of the economy that we don't want to be heavily invested in during this particular part of the economic cycle. Energy, financials being two of the most popular ones that are in the news a lot with how much they're down, being in that. Technology is also one where there's parts of technology that we can invest in. There's also parts that are not doing well or that. This next chart is from a research firm that I found really helpful that put this out just this past week. And what we see is this is a chart of the S&P 500. And this is a technical moving average. And what we've seen is after the huge downtrend in March, around March 23rd, March 24th, and the market has had a pretty voracious, what we call a bear market bounce, back up to pretty close to 2,900 as of a day or two ago. It had gotten over 2,900, and then today, as we're recording this, it's back under 2,900 here on May 1st. But one of the things that this chart points out is that the S&P 500, it tends to have a test at what is called its 20-month moving average. And so the moving average is this blue line. And what you'll see is back in 2008, when during the Great Recession, when the market rallied back, it hit this 20-month moving average, and then it gave resistance, and then it bounced back down before slowly working its way up. Similarly, in 2001, 2002, in the dot-com bubble, the market, after a sharp downturn, began to come back up. It hit resistance at its 20-month moving average, and then it began to retrace back down. We believe we're in a similar type setup to where we do not think that a V-shaped market rally is really sustainable. We look at this, the 20-month moving average is somewhere right there around 2889 on the S&P 500. And so we've seen the market start to find resistance there. It went up over that here earlier this week. If it can close above the 20-month moving average on consecutive days, then there's a possibility that the counter trend rally will continue to go up towards 3,000. But this is a key point to look at, a very pivotal one, in that the market today, as we record this, is the S&P 500 is down 2 or 3%, and it's come back off of that resistance level. So this is very important for us to look at when we want to make decisions on how to deploy investor capital. We want to look at these trends, because what we don't want to do is we don't want to be buying up here at these top levels and then have to ride it back down. So this is one of the charts that we look at to inform us of how to invest. This next chart is what's called a waterfall chart, and the dark blue chart is the S&P 500 and what it has done through this recent downturn. And so we see that we had the really sharp downturn, and then we've seen a really sharp rise back after this huge waterfall decline. Now the light blue chart and then the orange dotted chart. The orange dotted chart is 1987. And what the markets did in 1987, when there was another waterfall decline straight down, and then it bounced back up and then slowly had to work its way out. And these are months prior to the waterfall. So the waterfall here started in February and into March, and then in 1987 and also in 1929, when the market had a waterfall decline, we saw that we had these bear market rallies, but then it took, 3, 4, 5 months, in this case, kind of 5 months plus before it really started finding its footing on that. So again, we do think we're closer to a bottom, but based on this waterfall chart, we would expect a test of the lows over the next few months as this works itself out. These are just a couple of observations on waterfall declines. After a waterfall decline, which has happened 13 times, 12 of the 13 times there's a retest down to those lows. Now, 9 of these times it has resulted in new lows. And so for the current market, that would put us testing the 2300, upper 2200 level on the S&P 500 if we reach new lows. Either way, on this chart, we do think we're going to see some retest at lower levels. It may not go all the way down, but it wouldn't surprise us to see downturn, 10, 20+% on the broad market. The one exception when the waterfall decline did not have a retest was the fourth quarter of 2018, when the Fed was tightening too early and there was a threat of trade war with China that dissipated. One of the key observations from this is when we see a strong rebound, as we saw in the month of April, history and data point to the observation that the retest will occur, but it may not be as severe as it could have been. So we think that the base case would be a retest is likely to occur over the next couple of months, but based on how strong the rebound has been, it may not be as severe. We may not actually hit the March 23rd low on the S&P, but we would definitely see a retest down to those ranges, but maybe not a new low. And again, this chart is just bull and bear markets. This is the S&P 500. This looks at the market from 2007 to 2009. And you see here, this is really the financial crisis, which many of us remember on that. Bear markets tend to take several months to play out. Bear markets are generally not over in 2 months. So this is a longer term process. What we saw here in 2007 and 2009 is that, over 408 days, the market was down 50%. But during a bear market rebound in here, over a 47-day period, the market was up almost 25%. But then right after that, over the next 62 days, it was down 27%. So this is a type of case that we need to be prepared for as we protect capital and invest portfolios. Although we've seen a sharp rally, we could easily see another downtrend on it, just like we did in 2008. This chart is from Howard Marks, and I think it just really represents a simple napkin drawing, if you will, of where we are in the economic cycle. Coming into the first of the year, we were really at the top of that chart. We were here, the red box. And now, here at the end of April, we're probably somewhere around that orange box. As of the printing of this chart, we're probably a little higher than that now. We're probably, a lot closer to where we were in February. The line that goes through here is just the 10-year return estimate. And this is more of the median return 10-year estimate. Ideally, in a market cycle, the best time to be buying is when the valuations are down here around this green box. Now, it's not a perfect science, but we know we don't necessarily want to be buying volatile securities here at the top. We want to be mindful of that and be in the right types of asset classes that will help. So that's a quick summary here in this video. I'll follow up with the second video, part 2 of this one. But again, this is just to give us a bit of context on where we are with the markets. And again, if you have specific questions, you can visit us at AuthenticCounsel.com. And again, this is Chad Franzen, Certified Financial Planner. And be safe, take care, and invest wisely. And thank you for your time. And this concludes part one of our current market summary for April 2020.